So today we are going to start with section 36, subsection 1 and clause 8. So this particular section talks about the deduction which can be claimed in cases where a certain amount has been transferred to a special reserve. Has been transferred to a special reserve, right? So, who are the eligible SSCs here? So, for this particular section, the eligible SSCs are any kind of financial institutions who provide long term borrowing or who provide long term loans. So, in this section, what do you mean by long term loans? It means the loans which are being provided for more than for 5 years or more, right? Loan for 5 years or more. In that cases, the loan is known as your long term loans. So, here the eligible SSCs are the financial institutions who provide long term loans, right? So now we will understand who are the eligible SSCs in a bit detailed manner. So the first eligible SSC is any kind of financial corporation specified in section 4A of Companies Act. For example, financial institutions like banks, IDBI, ICICI, IFCI, etc. The second point says any kind of financial institutions which is a public sector company, which is a public sector company. And lastly, it says that banking company, including cooperative banks, engaged in the business for providing long-term finance. So the last point says what? Banking companies who are engaged in the a business of the following three things, which I'm going to tell you, and they provide loans for this particular thing, right? So, what are the three fields in which, if the financial institution is providing loans for, then the financial institute is eligible for this particular section. The first field is that industrial or agricultural development. Industrial or agricultural development. The second point says that development of infrastructure facility in India, right? The third point says development of housing in India, right? So in this particular section there are 3 points, out of which now we covered only the first point. The first point says that if any kind of financial corporation who is either a company under section 4A of Companies Act, or who is either a financial corporation which is a PSU or public sector company, and lastly any kind of banking company who are engaged in the following three businesses. What are the three businesses? The first is industrial or agricultural development. The second is development of infrastructure facilities in India. And the third point says development of housing in India. Right? Understood? So all these SSCs are eligible to claim deduction under section 36(1). Right? Which kind of deduction? Where a specific amount has been transferred to a special reserve. Right? Now, the second point says that housing finance company which is engaged in business of providing long-term finance for construction or purchase of houses in India for residential purpose, right? So this particular point, which is your point number 2, जो ऊपर का तीन था, that was your point number 1. Now we are starting point number 2. So the point number 2 says what? It should be a housing finance company, for example DHFL, right? And it must be engaged in the business of providing long term loans. This is the second condition. Third is what? The long term loan must be either for construction or purchase of houses in India for residential purpose, right? So it must be a housing finance company. The second point says that it must be engaged in the business of providing long term finance. The third point says that the long term finance must be provided either for construction or purchase, construction and purchase both, right? And the third point says that construction and purchase of house in India, the property must be situated in India. And lastly, it must be for residential purpose, right? So in that case also the SSC can claim deduction under section 36(1), right? The last point says that any other financial corporation, including a public company which is engaged in the business of providing long term loans for the development of infrastructure facility in India, right? So the third point says what? Any other financial corporation, including a public company. It can either be a public company or it can be a private company. Okay, so and it must be a financial corporation who is providing long term loans for the development of infrastructure facility in India. So this particular section was brought into force, जो कि यहाँ से clear हो रहा है, right? This particular section was brought into force to accelerate the growth in India in three things: industrial and agricultural development, development of infrastructure facilities in India, and lastly, development of housing plans in India, right? So now we will understand what amount of deduction can be claimed under this particular section, right? So there are 3 points, and the lower amount of all these 3 points can be claimed as deduction under this particular section. So the first point is the actual amount transferred to the special reserve, the actual amount transferred to the special reserve. The second point says 20% of your PGBP income, 20% of your PGBP income, which is computed with the provisions of section 28 to 44 AD. That defines your PGBP overall, right? So 20% of your PGBP income or PGBP profit, right? And lastly, it says that 200% of your paid up share capital plus your general reserve, minus opening balance of reserve. 200% of your this is inside the first bracket, that is your paid up share capital plus general reserve, and 200% of this paid up share capital and general reserve minus opening balance of reserve, opening balance of that reserve. If the all these three points you write down, and the lowest amount of all these three things will be taken as your deduction. You can claim the deduction amount as the lower amount of all these three things, right? Now, we understood who is the eligible SSC in this section. The next, we understood what will be the amount of deduction, and lastly, we will understand that if any amount is withdrawn, from the reserve account, a special reserve account. See, you are getting the deduction because you are transferring that amount into that special reserve account. But if you are again taking out that particular amount from your reserve account, then what happens? So in the amount in the year in which the amount is withdrawn, in that particular year the entire amount will be chargeable to tax under section 41 clause 4a, right? 41 clause 4a. And here it does not care whether the business is in existence or not, right? आपका बिजनेस चल रहा है कि नहीं चल रहा है, it doesn't really matter, but in the year in which you are taking the amount out from the special reserve, or you are withdrawing the amount from the special reserve, in that particular year the entire amount will be chargeable to tax under your PGBP, right? So that was all about this particular section. Let's do a quick revision of this. Who is the eligible SSC? Any kind of financial institution who provide long-term loans for the three things. What are the three things? The first is your industrial or agricultural development. The second is your development of infrastructure facility in India. Lastly, development of housing in India. Right? The first point says that the SSC must be a financial corporation under Section 4A of Companies Act. The second point says that any kind of financial corporation which can be a public sector company. The last point says that any kind of banking company, including the cooperative banks who are engaged in these three businesses. Now coming to the second point says that housing finance company which is engaged in the business of providing long-term loans to construct or purchase houses in India, and the houses must be for residential purpose. And the last point says that any kind of financial corporation which is providing long-term loans for development of infrastructure facility in India. Right? Understood? And also, what is the amount of deduction in this particular section? The amount of deduction is lowest of the following three things. The first is the actual amount transferred to the special reserve. The second is 20% of your PGBP income or you can say 20% of your PGBP profit. The third point says what? It says that 200% of 200 multiplied with your paid up share capital plus general reserve minus your opening balance of the reserve, right? 200% of your paid up share capital and general reserve minus opening balance of your reserve. The lowest amount of these three things will be your amount of deduction. Understood? And if you are taking that amount out of your general reserve, out of your special reserve, so in which year you are withdrawing the amount, in that particular year itself, it will be chargeable to tax, right? Tax under your PGBP head. I hope this is clear to you, this particular section. And yes, if you find this video helpful, then please hit the like button, subscribe to my channel, The Witty Turtle, and also don't forget to hit the bell icon so that tomorrow you'll be notified when I'll upload a new video. And don't forget to share this video with your CA and CMA final friends.